So by popular demand from you guys in the comment section, you've asked me to talk about potentially are we heading into a UK stock market crash with all the taxes that the new Labour government are potentially going to put on investors and also every other thing out there. There's a lot of taxes that are being talked about. Can I talk about it and what impact can that have potentially going forward? Hope you enjoyed this video. Let's get started. Now, yesterday I did drop a video on the UK inflation at 1.7%, and I talked about this being a big problem. Not the inflation being the actual problem, but the reaction that we've had to the drop in inflation and how slow that reaction has been from the Bank of England. A lot of you guys seemed to enjoy that yesterday. If you haven't seen it, go check it out. But what I actually saw yesterday is a YouTube channel that I'm a big fan of, Damien Talks Money, and he actually talked about inflation, and he went from another angle, which was inflation is not below 2%. Now, I actually normally agree with Damien Talks Money a lot with the videos that he makes. Yesterday I didn't. I did not agree with his video that he did yesterday, which he was talking about potentially ignoring the more core data that the reported inflation data is with CPI and saying take energy out of it because energy is volatile. Now, I don't agree with that because energy is a leading indicator of what causes inflation. And I didn't know if you guys wanted to see a reaction to that video, but I thought, you know what, because I did a inflation video yesterday, I don't think you guys would appreciate back-to-back inflation data. But if you do want to see that, let me know in the comment section. But anyway, getting on to today's video. Is there going to potentially be a UK stock market crash with the upcoming budget on the 30th of October with a lot of the tax hikes that's going to come from the current new Labour government? And that's the video that you guys wanted to see today, and I'll give my thoughts on it. So, the first 100 days of Starmer's government have passed, and we do have the budget coming up on the 30th of October. We haven't seen a good time. In my opinion, I don't think the Labour government that's in at the moment have done a great job. They have backtracked and told a lot of lies, but hey, which government hasn't done that? We've seen the winter fuel allowance cut for a lot of pensioners at the moment, which is not a great look to have. And that's potentially after when Starmer said that he would not be doing this. I remember when he was criticising the potential of risk.When. Why is this big advert for Uggs women's slippers coming up, by the way, on the top of this this article here? But I remember him criticising Rishi Sunak when he was in charge about potentially cutting winter fuel allowance, and then he went and gone and done it himself. We've seen very much Labour mention that there is a 22 billion black hole at the moment that they need to fill, and that is the reason why potentially they're looking at a lot of tax hikes at the moment, and that's what everyone's worried about on the 30th of October when the budget does come out. Where are they going to fill this 22 billion black hole? But what I always think about is, well, at the end of the day, you got to look at Labour, and they've caused a good chunk of that 22 billion black hole. Obviously, the Conservatives are slightly responsible as well for some of that black hole, but Labour have caused, I think, something like 9 billion of it by handing out pay rises like crazy. I mean, to be going out and handing out 22% pay rises to junior doctors, in my opinion, is crazy, because you start handing 22% pay rises, it's not long until all the other unions go, hey, you've given them a 22% pay rise, hey, we want a 22% pay rise, and then you have inflation cycling up again, and also what you have is a bigger black hole to fill where you have to go raise more taxes, and that's what Labour have caused from doing all these crazy pay rises at the moment. And so much what we heard from Labour and Starmer when they said they had a fully planned costed manifesto, and yet you look at the moment and going, well, it's not fully costed because they're going to have to go raise money from somewhere at the moment. And the other thing that you look at is that the one thing that I actually thought Labour would be very good at is that hey, they're going to actually start to plan to freeze the energy price cap at the moment, which, and also do a windfall tax on these energy companies that are profiteering from these extortionate energy prices, and they haven't even followed through with that, which obviously isn't great. But getting back onto the point at the moment, are Labour going to cause a UK stock market crash on the 30th of October when they do the budget? So there's a lot of fear out there at the moment. We've seen UK landlords are rushing to sell their properties ahead of potential capital gains tax rises. We've seen a lot of senior membership in businesses. I think at the moment the figures are saying that there is double insider ownership selling than normal, if that made sense. So yeah, there's more insider sales going on at the moment by the double the normal amount, which isn't good. And we've seen a lot of UK funds selling a lot of UK stocks. We've seen the decline in a lot of the UK businesses at the moment. If we did look at the FTSE 250, since Labour have come in, it has underperformed what it has done the rest of the year, which is a sign that everyone's getting a little bit nervous around the UK at the moment and what's going to potentially come through the autumn budget that happens. Now, the first thing is that we've seen mentioned in the media is AIM shares. So at the moment, they have a inheritance tax break. So if you pass them on, obviously you don't have the inheritance tax on them. And the one way that they are potentially looking at raising taxes is saying actually they're going to get taxed the exact same as other shares when they are inherited. I actually don't think this is a bad move. I do think that they probably should be taxed the same on an inheritance point of view. I don't think they should have a special break because of they are seen as more volatile companies, they can change a lot more. I don't believe all that rubbish. I actually agree with that if they are going to go for the AIM and put inheritance tax back on these stocks, I don't think it's a terrible thing. And I don't think they should have some special tax break. I mean, a few people said that AIM stocks will fall 39%. I don't think half of the investors are going to end up selling their AIM stocks because inheritance tax has been lost. I think that's just some big money that's trying to cause fear out there that potentially use it as a bit of a loophole to save inheritance tax on it. I actually don't have an issue with this one. So for me, I don't think that will cause much of an issue, even though there's been claims out there that it will cause a 39% drop in AIM shares. I think it's absolutely fine. The one that I do have concerns on is that the raise in capital gains tax at the moment, and there is reports that capital gains tax is going to go to the same as income tax, which I don't agree with, because at the moment, if you look here, so you've got 24% gains on residential property, 28% gains carried interest, and also 20% on gains on other chargeable assets. Unless you're on the basic income rate, then obviously it's a little bit lower than that. But at the moment, the tax rates are a lot lower than what you would normally pay on your income tax. So, for example, if you were to sell some shares and you're on the higher income tax, normally on your higher income tax you're paying about 40%, but on your assets, if you sold some stocks that you made money on, it's about 20%. And I think that's fine. I think that's absolutely fine, because what you have to remember is that if you are an investor and you're taking on the risk of, let's say if it's either property or stocks, if you're buying some property, you're taking on the risk that you buy a property and you might end up finding that you've got an awful damp problem in that house. You might find out you've got a big structural problem. You might get an awful tenant. There's a lot that can go wrong with residential properties. So you can't charge the same capital gains tax as your income tax, because there's risks that you've took on as an investor by buying the property. It's same with stocks. You can't charge more than 20% on your capital gains on stocks because you've took risk on. You can't charge it at 40%, the same as your income tax rate, because it's not guaranteed like your income. You've took the risk on. If I go buy a stock, there's no guarantee that I'm going to make money on that stock. If I lose money on that stock, the government aren't going to come out and say, oh, you know what, you actually lost money on that one, we'll give you some money back. There's none of that. With investing and the capital gains tax, you're taking that risk on. So you can't tax the same amount as income tax because you are taking on that risk. You can't say that we're charging the same money as guaranteed income. It's just wrong. There's got to be some reward for investors. That if you are taking that risk on with investments, you can't then do capital gains tax the same as income tax. I would argue the case that even if it's not 40%, even if it was to go to the rumoured, I think there's like 35% out there, there's 32% rumoured out there, I don't even agree with that, because there's got to be some reward as investors. As investors, you're taking the risk on. You've got to be having at least a decent upside. You can't go buy a stock and then make 100% and go, hey, I made 100%. Oh, by the way, you took all that risk on and you made 100%. You got to give 40% of it to the government. That can't happen. There's got to be a point where there's got to be a risk to reward for investors. They're taking this risk on. You've got to reward them. And I'm a little bit worried from this point of view that if they are going to do this sort of investments, that's going to put a lot of investors off from going and taking that risks. That's the big issue. And the other big issue that I have is that this is already going to be on what has been a tough kind of 2 or 3 years on investors by the previous Conservative government. The Conservative government wasn't kind to investors either, in my opinion. You look at what they did, they reduced the dividend tax allowance. They took the dividend tax allowance from 5,000 down to 2,000, down to 1,000, down to 500. Once again, you're punishing investors. All of a sudden, investors go, oh, you know what? I get 5,000 in dividends before I even have to start paying taxes, and then you punish them once again from this point of view. You're looking at the capital gains allowance. So you're already talking about potentially having to pay higher capital gains tax. But you used to have the capital gains allowance where you earned a certain amount and that was protected and you didn't have to pay tax on it. But you look at that point of view that you've gone from, we were going up nicely until 2020, and then we got frozen and we never went up any more than that. And then we had it taken away from us in the last 2 years. The capital gains tax allowance went down from 2,300 down to 6,000 down to 3,000. So investors have already been punished because the dividends allowance has been cut, the capital gains tax allowance has already been cut under the Conservative government, which I don't agree with. You've already had a lot of reward from investing taken away from investors. And when you look at the ISA allowance, the great thing that a lot of people say, well, you still have a generous ISA allowance, which is good. For a lot more smaller retail investors, you should be okay. If you are a smaller retail investor, you won't be affected that much because you have your 25%, your £20,000 stocks and shares ISA, which is tax free. There's talk now that potentially the ISAs are going to get hit, I would be shocked if they go that far. I'd be really shocked, and I'd be annoyed if they actually do start touching the ISA allowance or capping the ISA. But for smaller retail investors, a lot of them are okay. You've still got your 20,000 allowance, which, by the way, I don't think even that should have gone up slightly. I mean, 20,000 is quite a fair amount for a full year, to be fair, but we've been at 15,000 for like a decade now. So at some point, I think that in my opinion, if I was running the country, I would put the ISA allowance up with inflation every year. That's personally what I would do. But we haven't had an increase since 2016, nearly a decade now. So I feel like the ISA should, if they are going to do this, the ISA should be at least topped up a little bit to 22, 23,000. I think there has to be some reward there. But the big thing is that these guys that are putting 20,000 into, let's say, in a stock market, for example, or the retail investors, a lot of them aren't the guys that are going to move the stocks. We need to attract the big money into the stock market in the UK, and we've already had businesses hit as well where they've had to also pay higher corporation tax. We've just gone from 19% up to 25%, which once again was under Conservative government. So under the Conservative government, they've already slapped a lot of UK investors with higher taxes that are hurting profitability. That's why a lot of companies aren't even growing profitability this year. They've had higher wage increases, and then they've also had tax increases. They've had their profitability hurt as well, which isn't great. And now on top, investors in the UK have been hurt by what potentially could be a Labour government, where we're going to have, maybe I'm not too concerned around the inheritance tax around the AIM stocks, but if we're going to have higher capital gains tax, I think that's just too much for investors. And if anything, we need to be attracting the big money into the UK stock market, because at the moment there's already not enough big money coming in. If we start making it harder where they are losing tax breaks or cheaper tax on taking riskier investments, we're not going to have the big money coming in. The big money is going to be thinking, I'm not going to put my money into the UK. I'm going to go put the money somewhere else in another market, or potentially they're going to move the big money into other countries, which happened previously under the Labour government in the 70s. All of a sudden, the Labour government in the 70s went, we need to make more money. What we're going to do is we're going to tax a lot of people, and then all the wealth moved out of the UK economy, and they went, hold on, everyone's moved out of the UK now, and we've lost all the money. People think the way to plug black holes or fix 22 billion black holes is just the automatic thing is, tax the rich, which certainly there's some elements where you can look at where there's potentially tax that they can make up from. But the ultimate thing is that you can't do it where it sacrifices your economy and businesses and investments, because what that has the effect on, that feeds down the ladder. People sometimes don't realise this. Having money, the big money spent in the UK, feeds down the ladder and makes people further down the pyramid. They get the money then. And that's what you want to do. You don't want to start cutting off the top, because then it won't filter down. And with some of the things that are considered, I think it would potentially stop the filter down the pyramid, which is what you don't want to get into the situation from. And if you look at the UK, for example, at the moment, I probably should have got this up right now, but if you look at the UK stocks at the moment, a lot of them are trading very cheap. A lot cheaper than what they've historically done, and a lot cheaper compared to what you'd get the same businesses in, say, like the US, for example. That's why we've seen a lot of UK businesses bought out this year. If you look at the likes of Darktrace, one of my big investments this year, that was bought out by a US investment firm because they looked at the UK stock and went, that's a bit cheap for how good that business is. Another stock I owned this year, Hotel Chocolate, got bought out by Mars because they looked at it and thought that's quite cheap for how quality that stock is. We're going to go buy it out. And these premiums are like 100% premiums on the stock price. There was, we had Keyword Studios that was bought out for nearly a big premium from where it was. We even had Rightmove the other day, looked at potentially being bought out. All these, there's a common theme here where at the moment we're having so many UK stocks being bought out because of the cheap valuations, and people abroad are thinking, these UK stocks are so cheap compared to what valuations they are in, like if it was a similar company in the US. And that's what we want to avoid. We want to avoid losing all of our UK businesses because they're all so cheap, and they think, you know what, our share price isn't getting reflected here for how good our business is. Why, we've just had this offer for double the share price. Why don't we just, sell it up and take the money now? And that's what's happening, because at the moment the UK is struggling to attract IPOs and also the big money into investing into the UK. We don't want to have a situation where we then make it even less attractive for the big money to be invested into the UK because the risk is gone. We don't want to be in that situation because once again we get into that system where the big money isn't filtering down the pyramid, and people don't realise this. Quite often, like I said, the black holes are talked about being, tax the rich, but you've got to be very careful about how much tax you start asking them to pay, because at some point, when does the risk reward go from their point of view, that they go, I'm not taking this risk here. I can go buy so-and-so stock in the US and get potentially a lot better return on them guys. Look at how the US markets perform to the UK markets. And that's the big risk you don't want to have. And I guess it kind of comes a bit to a conclusion now, is like, do I think that the government and Labour will crash the economy on the 30th of November? And the answer is potentially. I do. I think if they come out with two ridiculous tax rises, I do think it will put the big money off investing in the UK, and we will hit a stagnant patch in the UK while investors do digest it. The other thing is that potentially we've had all this kind of fed to the media, and they're trying to get the government are trying to get the feeling of, okay, what's the reaction if we were to put this tax up? What's the reaction if we put this tax up? And then eventually they go, okay, that seems like the one we're going to go with. And potentially this is being all overstated, and maybe they're not going to these extremes. And then all these concerns, the market doesn't like uncertainty, and that's what we have right now. And all this uncertainty kind of goes and goes, actually, you know what? The only thing they kind of, followed through with was their AIM tax. That's the only thing they followed through with, and that's not actually too bad. And we might actually see on the 30th of October, the markets actually might rally, because it might be that relief of like, actually, we thought we were going to start getting taxed 40% on capital gains here, and actually we've only got this one tax, so it's all right. And the market might rally on that. There's also the potential that, hey, our worst fears might even get, we might not only get the AIM tax, we might get the capital gains tax, and then we might even have ISAs capped. And if that's the case, yeah, we could be in a bit of a bad situation, and that could happen. So, I mean, I sound a bit pathetic, really, because I'm kind of sitting on the fence here, but it's also, you can see why the stocks are sold off, because there is the uncertainty. We could be in a place where we actually go, actually, that wasn't too bad, but we could be in a place where we get shocked and go, wow, we knew we were going to get tax hikes, but we weren't thinking it was going to be this many and this much, and that might shock us as well. So we don't really know. What I will say is that, for me, I'm not changing my investing plan at all. I am keeping a little bit of a cash pile on the side, and then I will reassess it once I see what happens on the 30th. I mean, realistically, I hope, I said I hope, I don't know if I'm being a little bit too optimistic here, but I'm sure the government isn't as stupid to go and hike up multiple taxes in one budget. Now, I don't know if I'm being a bit too optimistic here, but I hope it's not that stupid to go do it, and I hope it's sensible, and it just puts in maybe one tax hike in this sort of sector, and we go, you know what, we can live with that, let's move on from here. I hope it's sensible. I hope they are sensible about it. I mean, we don't know, but that's my feeling at the moment. So if you were to push me for an answer, I feel like the government won't be stupid and put a million tax hikes up, and we'll be okay, and we'll actually see a bit of a rally on the 30th of October. But you never know. We never know. I am open to being surprised, and I won't be shocked if that is the case. So we'll see. We'll see. A lot can happen anyway. So my thoughts, yeah, I'm a bit on the fence with it all. But that's if you were forcing me to pick a situation that happens, that will be the situation that I think will happen anyway. Hope you enjoyed the video, guys. See you in a bit.